Hello financial fans, welcome back to another stock analysis. Today we'll be covering Wells Fargo stock ticker WFC. Wells Fargo is a financial services company that provides a range of financial products and services to individuals, businesses, and institutions. Some of the main services offered by Wells Fargo include banking services. Wells Fargo provides personal and business banking services such as checkings and savings accounts, credit cards, loans, mortgages, and investment accounts. They also do wealth management services. Wells Fargo offers wealth management services to individuals and institutions, including investment management, trust and estate planning, private banking, and retirement planning. Wells Fargo also does insurance services. Wells Fargo provides various types of insurance services, including life insurance, property and casualty insurance, and employee benefits. They also do investment banking services. Wells Fargo provides investment banking services to companies including underwriting of securities, mergers and acquisitions services, and capital raising services. And lastly, they do payment processing services. Wells Fargo offers payment processing services to businesses including merchant services, electronic payments, and foreign currency exchange. They are currently sitting at a $159.9 billion market cap, and in 2022 they generated a revenue of $96 billion, and the dividend yield is currently sitting at 2.9%. 45% of their revenue comes from consumer banking, 19% from corporate and investment banking, 19% for wealth and investment banking, 12% from commercial banking, and the remaining 5% from corporate. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and light green, or bright green rather, will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone down over the years, going from $28.4 billion in 2012 to almost $15 billion in 2022. The average decline in EBIT is 7.6% annually, which is a 5% increase in the margin of safety. The margin doesn't look very much better. It's gone from 33.65% in 2012 to 20.29% in 2022. The average decline here is 7.2% on average, which is a 5% increase in our margin of safety once again. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over years, going from 23 cents a share in 2012 to all the way to 51 cents a share in 2019, but then going to 10 cents in 2020. But it has managed to regain itself somewhat, going to 30 cents again in 2022. The average dividend growth is only 4.4%, which is no change in the margin of safety. But this is with a payout ratio of 35%, which is once again no change in the margin of safety. The last two ratios are the debt to EBITDA and the assets under management CAGR. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see on the top left, their cash position is currently greater than their debt, meaning that they can pay off all of their debts using just their cash. This indicates a 0% debt to EBITDA ratio because Wells Fargo has no net debt, which is a 5% deduction in a margin of safety. Lastly, we have the assets under management CAGR. As you can see, they had in 2017 $1.9 trillion assets under management, but this has gone down to $1.8 trillion in 2022. There's still a very small growth, but this is only 0.02%, which is no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Wells Fargo. First model that we'll be using is the dividend discount model. I've imported the dividend payouts of Wells Fargo going from 2018 to 2022. The average growth rate in dividends during this period was 23.14%, and I'm projecting an expected growth rate in their future dividends of 6%. I will be using a 9% discount rate in this valuation, giving us a dividend discount model price per share of $42.40, which is a 2.51% upside from the current price. The second model that we use is Graham's device valuation formula. In this model, we look at the earnings per share that Wells Fargo is generating, growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always standing at 4.4%. And we go by the theory that a company with no growth is always sitting at a PE of 7. This gives us a Graham's price per share of $34.54, which is a 16.5% downside of this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to Wells Fargo, look at their stock price and their earnings per share. This way we can determine the average P multiple in the industry, which in this case is 9.37. All you have to do to get a multiple valuation price per share is to multiply by the earnings per share that Wells Fargo is generating, which in this case is $3.14, giving us a price per share of $29.42, which is a 28.87% downside of this model. The fourth model that we use is the price to tangible book value. In this model, we look at the tangible book value per share of the same peers, and then divided by the price to get our price to tangible book value ratio. On average, for these companies, it's sitting at 1.56. Doing the same for Wells Fargo, the ratio is 1.26, meaning that it's currently cheaper than the average, giving us an upside, or rather giving us a price per share first, of $51.27. This is an upside of 23.96% out of this model. And the last model that we use is the cost to income ratio. In this model, we look at the interest expenses and interest income of the peers that we used in the prior models as well. This gives us the cost to income ratio, which on average for these companies is sitting at 33.68%. Doing the same for Wells Fargo, we get a cost to income ratio of 16.8%, meaning that it's currently severely undervalued on this metric. This gives us a price per share of $82.93, which is a 100.5% upside of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at a final overview, we've imported the discounted dividend, Graham's valuation, the multiple valuation, the price to tangible book value, and the cost to income price per share, giving us an average of $48.11. A margin of safety we've determined earlier using the standard margin of safety of 25%, adding 5% for the EBIT growth, adding 5% for the margin growth, and deducting 5% for the debt to EBITDA, giving us a 30% margin of safety. Applying this margin of safety, we get a fair value of $37.01, and with the current price of $41.36, we get a downside of 10.52%, indicating that it's currently a sell out of our valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.